In a recent post, our next guest highlighted the potential for crude oil to climb to $70 in the second quarter with some caveats. To discuss the technical picture for oil, the transport, social media stocks, JC Parets from allstarcharts.com. He's also the founder and president of Eagle Bay Capital. JC, good to see you. One of the interesting comments you made to us in an email you sent to us, this whole idea of risk management. Go through Risk Management 101 for us and how you use the charts to manage risk.
Yeah, and I'm glad that you mentioned it. Again, thanks for having me on as always. But yeah, I think you nailed it. I think risk management is really the most important thing here. Really for market participants, it's not so much being right. We're only here to make money, and there's a big difference between the two. So we really pride ourselves on not having any egos. If we're wrong, we move on. So throughout the day, and me, I'm looking at charts all day long. I send you stuff all the time. For me, it's all about looking for risk-reward opportunities where that ratio is very much skewed in our favor. So for every dollar of risk that we might be putting on, we want to be able to make at least $6, $7, if not even $10 on that trade, having that 10-to-1 ratio or 6-to-1 ratio, and that's really where the charts come in. I know in a minute we'll get into the crude oil. We can explain at that point, risk management-wise how that works. Same thing with the transports that we're going to talk about. But it's all about defining that risk before you put the position on, knowing where you're going to be out if you're wrong, knowing where you're going to be out if you're right. And the idea is to have the ratio of when you're right to wrong, much higher, obviously.
Most people don't go into a trade with having all of that in their head, and they certainly should. Let's use the transports maybe as a bit of an example as to how you're managing risk with this particular index. It hasn't made a new high since last November. It's kind of been stuck in a channel. We're showing that channel right here on the screen. How do you think about the transports? Because some people think it has to be a leader for the rest of the market to go higher.
Yeah, and I think this is actually a great example because there's two ways to analyze risk in this particular case. I was on the show in mid to late February with you and we were talking about the transports, and one of the things that, I was focused on was that the Dow Jones Transportation Index had yet to break out like the industrials did, like S&P 500, Nasdaq 100, Russell 2000, the mid-caps were breaking out already. So the transports were really the only ones that hadn't broken out, and we wanted to see new highs. We peaked in November, as you mentioned, and we've gone nowhere for 4 months. So, until we break out, there's really no reason to be involved. And then the idea behind that is we buy the breakout, and if for some reason that fails and we get back into this range, all bets are off. So price-wise, risk management is very well defined. But in addition, notice how we keep talking about waiting for that breakout. Until it breaks out, there's no reason to be involved, and that's a risk also. There's something that we call opportunity cost, right? If we're in something that has yet to break out and we're stuck in this range, that's money that could be better used elsewhere in other things that are moving that can make us money. So in this case, it's not just about the price risk. There's also opportunity cost as well, which I consider risk also, that a lot of people don't factor into that equation.
Let's talk about oil, which you could say has been kind of in a range with the lows defined by, low 40s, 42, 43, depending on what contract you're looking at. How do you play oil here? We're looking at a very shorter term. We're looking at 3 months on oil. We'll look at a longer term graph just in a second. What is the risk management for oil right now?
Yeah, and I think that's another one that's super clean. We made new lows in January, which, we ultimately made fresh lows in March below those January lows and then quickly recovered. So we love to see that. You and I have talked about that. That's exactly really what I was hoping for, really. And then momentum diverged positively. So as prices made new low in March, momentum was putting in a higher low. That's what we call bullish divergence. And you can essentially call it a failed breakdown in March, potentially. So risk management-wise, we only want to own crude oil if it's above the January lows. Let's call it 47.5. Below 47.5, we want nothing to do with crude oil, but above that, and I think a squeeze can get going, because remember, from a sentiment perspective, we're at historic bearish extremes. We're coming off levels that we haven't seen in a long, long time in terms of bearish sentiment. So that unwind can potentially create a very nice squeeze to the upside. So getting back to a risk-reward ratio skewed in our favor, the risk is very well defined. We only want to be in above 47.5, and we could potentially see $70. I like that risk-reward.
Meanwhile, the U.S. dollar, the sentiment towards that was just outrageously bullish up until about a week and a half ago. We've pulled back. We're trying to rally again. You got a little cautious on the U.S. buck.
Yeah, we hit a lot of upside objectives. We look at a lot of Fibonacci extensions, as you know, on daily and weekly time frames, and those were all hit a few weeks back. Meanwhile, we're at bullish sentiment extremes that have never been seen before, and our data goes back a long, long time. And meanwhile, the commercial hedgers are hedging these things. This is the smart money, or what we consider the smart money. They're hedging the U.S. dollar like it's going to zero. We've never seen so much hedging, from the commercials. So, it's not something we want to be buying here. I'd be looking for some sort of correction or continued correction. It's already been correcting. I wouldn't put new money to work in the U.S. dollar at all. To the contrary.
One of the areas which has been hot, they've been able to be kind of picked off one by one, Facebook, Twitter. The one I wanted to talk about is Google, which has really done nothing for a year. A lot of volatility, wide range, but dead flat if you had been away on a desert island for a year. How does Google look?
Man, big picture, Francis, this thing looks good. We had a monster run 2012, 2013. And those gains have really consolidated in a very healthy way. Markets need to digest those gains. They can't just go up forever. But the way that it's done that, some technicians might call it a bull flag. Call it whatever you want. It doesn't matter. They've really consolidated sideways over the last year and change. And I really think we're going to get an upside breakout. If we take out the highs from this month, I would consider that a confirmation that should probably take Google up towards 700. I'd be a buyer of that breakout if and when it comes. And I'm in the camp that probably happen soon.
JC, I'm going to leave it there. I'd like to leave on a positive note. Thanks for taking the time this morning. Have a good Easter weekend.
Thank you for having me. You too.
JC Parets, the founder and president of Eagle Bay Capital. He was in New York.